Welcome to MoneyMetrics Workshop on Personal Finance. This is Sridharan from MoneyMetrics. Before starting today's workshop, I'd like to share you an interesting information. It's about the profits made by our banks in 2020 pandemic. These are the profit made by our top Indian banks in 2020 pandemic. HDFC Bank reported around 26,257 crores of profit. The State Bank of India reported around 14,488 crores of profit. And the ICICI Bank reported around 7,930 crores of profit. While in 2020 pandemic, every other industry in the country is struggling to run their business, banks not only running their business successfully but also reported more profits compared to last year. If you are surprised, welcome to the wild world of finance. Now let's see what are the things you will be learning in this workshop. First, you will be learning about the history of the Indian financial system, and then how banks legally multiply money and how we can do the same, and how to close your EMIs 2 times faster, and how to cut your monthly expenses by 10 to 15%, what are the top income generating assets in India based on last 5 years data, and how to build multiple income streams without a big salary, and how to quit your job in next 5 years without worrying about all the financial commitments. Now let's see the untold history of the Indian financial system and how British colonized India by controlling its cash flow. East India Company established 3 banks in 1800s. The first bank in the Bengal and the second bank in Bombay and the third bank in Madras. These banks were called the presidency banks. The main role of these banks is to finance the wars and colonize India. These banks collected money from wealthy European investors and financed the East India Company to loot India and shared its profits to its investors. With the help of money from these banks, General Wellesley defeated Tipu Sultan and Marathas and paved the way for Indian colonization. Later, these banks started printing Indian currency and controlled the entire Indian financial system for British. By controlling the cash flow of India, British looted India's wealth nearly 200 years. This is how our country became cash cow for the British and helped to win not one but 2 world wars. In 1921, British government reorganized these banks into one bank as the Imperial Bank of India. After independence, it became the State Bank of India in 1955. If you can control finance of a country, you can pretty much control everything in that country. And that's the power of real finance. And why personal finance is important? Personal finance is the process of managing your money to achieve your financial goals. We have made more than 10,000 tax filings for our clients. We have seen a lot of rich clients go bankrupt because of the poor cash flow management. Managing your cash flow is more important than earning it, and that's why we build MoneyMetrics. Without understanding the personal finance, you can't control your cash flow. Without proper cash flow management, there is no way to achieve your financial goals. Now let's see some of the money myths we have been taught. Is getting a loan or credit is a bad thing? Actually, getting a loan is not a bad thing if you know how to use it properly. But if you don't know how to use it properly, then it's really a bad thing for you. Only working hard makes us rich. It is also not true. Working hard doesn't make us rich, but only building assets and building multiple income streams by building assets only makes us rich. Now, before starting the workshop, please note, we will be seeing some technical concepts such as the inflation, time value of money, repo rate, etc. in this workshop, and how everything is interlinked with each other. If you are new to the personal finance, some things may be hard to understand first, but don't worry, after seeing some real life examples, it will be easier for you to understand the concepts. And I will be using MoneyMetrics to explain the technical concepts visually with some real life examples. In case if you don't have a MoneyMetrics account, you don't want to worry about it. Just simply try the concepts yourself with a pen and paper. Also, if you have any doubts, post your questions below. I'll answer each and every question personally. Now let's see the fundamentals of personal finance. At first, we will be seeing about the time value of money, and then the inflation and how it affects the consumer's purchasing power, and then the investment returns and its types, and the most important metric in personal finance, the net worth. Now let us see the time value of money. It is the core concept of personal finance. It is nothing but the value of your current money at a future date based on an assumed growth rate. It is also called as a future value of money. There are two ways to calculate the time value of money. One is using the simple interest formula, and the other one is using the compound interest formula. We will be using the compound interest formula because all the banks in India uses compound interest to calculate the time value of money. So the formula is P into 1 plus I into T, where P is the principal amount, I is interest rate, and T is the number of years. In case if you can't able to understand this, there's nothing to worry about it. We'll be seeing a real life scenario shortly. Time value of money may not be accurate every time because of the other economic factors such as the inflation rate and the interest rate at that specific period of time. But it does help us to make better investment decisions. Now let's see a real life example what 20 rupees per day saving would be worth in next 30 years. Let's say you are spending 40 rupees per day for a tea or coffee and decide to cut it down to 20 rupees per day and invest the other 20 rupees. Now let me open my MoneyMetrics account and show you what 20 rupees per day saving would be worth in next 30 years. Now I am signing into the MoneyMetrics account. Let's go to the investments page where we can add our tiny investment. Okay, I like to call this investment as my tiny T savings. The current value is 0 and the type of investment is recurring since we will be saving every month, and the monthly investment is around 600 rupees, and let us assume the expected yearly return is 10%. Okay, now as you can see, this is the monthly investment we'll be making every month, and the current value is 0 and the expected yearly return is 10% and the monthly return is 0. Now let's see what happens in 5 years. In 5 years, the 600 rupees monthly investment will turn into 46,000 rupees and it will generate around 390 rupees each and every month. Here the monthly return is nothing but the interest that is generated by the final matured amount. Now let's see what happens in 10 years. In 10 years, the 600 rupees monthly investment will turn into 1.24 lakhs and it will generate around 1033 rupees each and every month. Let's see what happens in 30 years. The 600 rupees monthly investment will turn into a staggering 13.68 lakh rupees and it will generate you around 11,397 rupees each and every month. As you can see, it doesn't matter how much you are investing. It does only matter whether you are investing it regularly. The size of your saving doesn't matter at all. Even a small savings can turn into a big fortune if you do it consistently. Now let's do it with a different scenario. Let's say I wanted to buy iPhone 12 for my upcoming birthday, and after finding out that it costs around 85,000 rupees, I don't want to buy it anymore, and I bought an Android iPhone and I saved 50,000 rupees. Now let's call the investment as Android Rocks, and the current value is 50,000 rupees. The type of investment is fixed, and let us assume the investment generates around 10% yearly return. Click submit. Okay. Now since this is not a monthly investment, you can see that current value is 50,000 rupees and the expected yearly return is 10% and it generates around 417 rupees each and every month. As I said earlier, the monthly return here is nothing but the interest that is generated by your final matured amount. Now let's see what happens in 30 years. In 30 years, the 50,000 rupees you invested will turn into 8.72 lakhs and it will generate you around 7,271 rupees each and every month. even if you stopped investing further. In case if you are wondering how your tiny 600 rupees monthly investment generates more income than your 50,000 rupees investment, it's the power of compounding. It really doesn't matter how little you save, all it matters is whether you are doing it consistently or not. Now congratulate yourself, you have not only learned about the future value of money, you have also learned about the difference between recurring and fixed deposits, and mainly the importance of saving and why the size of saving doesn't matter. You must have understood by now that size of your investing doesn't matter. If thinking your income is low and can't invest big, instead of worrying about the low monthly income, just invest whatever you can, but do it consistently. You'll definitely achieve your goals. As shown previously, 20 rupees per day generates 13.68 lakhs in 30 years and beats the 50,000 rupees investment by nearly 2 times. Building wealth is the same as the story of tortoise and the rabbit. Consistency is more important than the size of your investment. Being consistent and disciplined is how you can achieve your goals. Now, let's see about the inflation and how it decreases value of your money. Inflation is nothing but the rise in the price of goods and services that we use daily, such as transport, clothing, housing, etc. It may be easy to say it in words, but it's very hard to control it. Inflation occurs because of many economical reasons, but the one most important thing you want to know is it decreases the value of your money and it reduces your purchasing power. Average inflation rate in India is 6%, meaning your money loses around 6% of its value each and every year. Holding cash for the long bad idea, since inflation erodes the value of your cash. That's why you must invest your cash in a bank deposit or any other assets to save from the inflation. Now let's see a real life money metrics. Let's see what happens if you keep your money in cash for a very long time. Let's say you have in cash and want to keep it without investing in any deposits or assets. And let's name it as cash in hand and set the current value as 1 lakh. Select the type as fixed. Let's assume the average inflation rate is 6% and I'm entering minus 6% since inflation decreases the cash value. Click submit and done. Let's see what happens in 10 years. Your 1 lakh cash will lose nearly half of its purchasing power and the real value will be 53,862 rupees. Please note, you will be still holding 1 lakh cash in hand, but you are able to buy only for 50,862 rupees because the cash holding loses nearly 50% of its purchasing power. Let's see what happens in 30 years of time. Your 1 lakh cash will lose 85% of its value and only has the purchasing power of 15,000 rupees. Now see why holding cash is a very bad idea. Okay, now let's say instead of holding the cash and you are investing the 1 lakh amount in gold. Let's add the same in MoneyMetrics. Let's name it as gold investment. The current value as 1 lakh and set the type as fixed. And the expected yearly return is 10% and done. Let's see what happens in 10 years. Your 1 lakh investment will turn into 2.59 lakhs. Let's see what happens in 30 years. In 30 years, it will turn into staggering 17.4 lakhs. That's 17 times the return on your. If you keep that cash in hand, it would lose almost 85% of its value. Now you know why investment is the most important thing in personal finance. Now let's see the history of gold price for the past 20 years. 1 gram of gold sold for less than 500 rupees in 2001. You could have bought 10 grams of gold in 2001 for just 5000 rupees of your money. But in 2020, 1 gram of gold is selling for more than 5000 rupees. Within just 20 years of time, the price of gold increased more than 10 times. Or we can also say that cash lost around 90% of its purchasing power within 20 years. I hope you have understood about the time value of money, inflation, and how it affects your purchasing power. In case if you have any questions or doubts, please add your comment below. Now, let's talk about the next part of the personal finance fundamentals. Returns are nothing but the money you made or lost on an investment over some period of time. Returns are often calculated on an yearly basis. Now let's see the different investment returns. Depending on the assets where you are putting your money, you can generate returns on your money using one of these 4 ways. Interest income, rental income, capital gain, and dividend income. Interest income is the amount you received for lending your money. It can be a bank deposit or given as a loan to some other person. Rental income is the amount you received for letting others use your property or an asset. For example, it can be your house, commercial space, or car. Capital gain is an increase in your assets value over the period of time. A good example is the return generated from selling your land or gold. Dividend income is the distribution of profits by big companies to its shareholders. When a big company earns a profit, it is able to pay a proportion of the profit as a dividend to its shareholders. If you are invested in companies like Infosys or TCS or any other big companies, you can generate dividend income regularly. Sometimes an asset can generate you more than 2 different returns. A good example is the commercial building in a prime area. It can also generate you a good rental income, and also you will get a good capital gain. The great thing is assets can generate regular passive income for you. As the great Warren Buffett said, if you don't find a way to make money while you sleep, you will work until you die. Now, the last thing is the net worth. Net worth is one of the main metric in your personal finance. You can find your net worth by putting all your assets on one side and all your liabilities on the other side. Now minus your liabilities with your assets, that's what your real net worth is. It is nothing but the value of everything you own minus all your debts. When your liabilities exceed the value of your assets, your net worth will be negative. Negative net worth is common if you have big loan like house loan or business loan. Now let's see what are the things you learned so far. You have learned about the untold history of Indian financial system and the fundamental concepts of personal finance that includes the time value of money, inflation and its effects, and the importance of net worth. And then you learned about the investment returns and the 4 types of passive income from assets. Then why size of your investment doesn't matter, and how to build your income generating asset even with low monthly income. If you have any questions, please post your questions below. Now we are going to see the 5 steps in personal finance. The first step is setting your financial goals. The second step is know your metrics, the important numbers in wealth building. The third step is the assets first cash flow, the secrets of cash flow management and the science of getting rich. The fourth step is the 1% improvements, why failing is not a bad thing and how to achieve your goals without trying hard. And the fifth step is how to build multiple income streams without a big salary. Now let's see the first step in personal finance, setting your goals. Your goals need to be well defined, clear and specific. Without a well defined target, you can't achieve your goal. Secondly, you need to measure your progress regularly to achieve your goals. Like said by the great management thinker Peter Drucker, you can't manage what you can't measure. And your goals need to be attainable. Once you achieve that goal, then you can set your next big goal. And your goals need to be realistic and relevant to yourself. Finally, it must have a clear target date. It helps you to stay focused on your goals. Now let's move to the second step. In this topic, we will see about the important metrics in personal finance. The first important metric is your net worth. Let me open my MoneyMetrics account. You can see it visually. Here you can see below the assets. Let's say you have 1 lakh in your savings account and 2 lakhs in your bank deposits. So your total asset value is 3 lakhs. And let's say you are having a personal loan of 10 lakhs. Now just minus your liabilities value from your assets value. So 10 minus 3 is minus 7 lakhs. It is common to have a negative net worth if you have loans, but don't worry about it. You can increase your net worth gradually with the right investment. In this case, the net worth turns positive in 5 years' time. In 10 years, it reaches nearly 15 lakhs. Now let's see about another important metric in your personal finance. Let me open the assets page for you. It's your asset growth rate, or simply you can call it as your investment returns. It's nothing but the average growth rate of your investments. Let's say currently you have bank deposit with the 8% yearly return. Now you decided to make another investment. Let's add your new investment. Let's name it as your second investment. Add current value as 0. Set the type as recurring and the monthly investment 5,000. Let's say you are expecting 20% returns on this investment. Now click submit. Now your asset growth rate is 14%. You can see here how your assets grow each and every year. Within 10 years, it will become 32 lakhs. Also, this metric determines the growth of your net worth. Now let's see what happened to your net worth with this new asset growth rate. Previously, it took 5 years to turn your net worth positive, but now your net worth turns positive within 3 years. And in 10 years, your net worth will be 33 lakhs. Now you must have understood how your investment returns affects your net worth over the period of time. Now let's see the final but the most important metric in your personal finance. Let me open the cash flow page to show you that. It's your cash flow ratio. It helps you to track your spending your income on different categories. Let's say your monthly income is 40,000 rupees and you are spending 10,000 rupees every month as investments, then your income to investment percentage is 25%. And you are spending 10,000 rupees to repay your loans, then your income to loans percentage is set to be 25%. And you are spending the remaining 20,000 rupees as living expenses, then your income to expense percentage is 50%. These metrics helps you to control your cash flows more efficiently and avoid unwanted spendings. Now, let's see the next step in your personal finance. Building your assets first cash flow. Before seeing about the assets first cash flow, you must know what is cash flow management. Cash flow management is nothing but the process of controlling your cash inflows, meaning the money you earn, and your cash outflows, meaning the money you spend. If you are spending more than 20% of your income on building your assets, then you are having assets first cash flow, which is a good thing because the chance of achieving your financial goals is high. Expense first cash flow is nothing but if you are spending less than 20% of your income on building your assets, which is a very bad thing because the chance of achieving your financial goals is less. Let's assume your cash flow looks something like this. You are spending 50% of your income on expenses and 50% on repaying your loans. If you are having this kind of cash flow, you need to fix this as soon as possible. Let's see why having expense first cash flow is a bad thing. As you are spending all your income on your expenses and loans and not leaving anything on building your assets, over the period of time your expenses exceed your income and you will start borrowing money to cover the expenses. Since you didn't spend enough money on building your assets, there will be no income from assets. And the sad truth is, you can't achieve financial stability in your life with this expense first cash flow. It will destroy all your dreams and make you more poor. But don't worry, I'll show you how you can fix your cash flow in next few minutes. Now let's assume your cash flow looks something like this. You are spending 25% of your income on investments to build your assets and 25% of your income on repaying your loans and 50% of your income as living expenses. Let's see how your current cash flow increases your wealth. Even though you are spending only 25% of your income on building your expenses, over the period of time your assets will start generating regular income for you and it will exceed your income. Assets first cash flow helps you to build your assets faster and also helps you to achieve all your goals. The faster you are good at building your assets, the sooner you will achieve your financial goals and build a better future for your family. Now let's move to the next step in your personal finance. In this topic, we will see how you can change your cash flow from expense first to assets first with just 1% improvements. Let's see an example using MoneyMetrics. Assume you are getting 40,000 rupees salary and this is how your current cash flow looks like. You are spending 70% of your income on living expenses, 25% on loans and only 5% as an investment in building your assets. And you want to increase your cash flow towards assets. Now let's see all the living expenses. Here the third column shows the allocated amount to each expenses. And the fourth column shows how much you spent so far. And the fifth column shows how much available to spend. Let's say you are spending 8,000 rupees for food every month. Instead of making a big change, just save a small amount like 300 rupees from your food expenses. So now it becomes 7,700 rupees. And another 200 rupees by downgrading your broadband. So now it becomes 1,800 rupees. And also cancel services that you don't use regularly. Let's remove Hotstar since there is already a Netflix and a DTH subscription. Totally you saved 1,000 rupees from your expenses. You can split this amount into your investments. As you can see, now your investment increases to 8. Like this without making a big change that is hard to follow. Just make 1% changes each and every month. With continuous small improvements, you can definitely make a big change in your cash flow. Let's move to the fifth and the final step in personal finance. Building multiple income streams. Do you know on an average a rich person has more than 7 income streams? How do they generate their incomes? Were they all working in 7 different jobs? Definitely not. They generate multiple incomes through their assets. It can be an interest income from their bank deposits or returns generated from mutual funds or stock investment, or it can be an income from rental properties they own, or it can be an income from business investment they made. It doesn't matter where these incomes come from. The important thing is, if you want to get rich and achieve your financial goals, you must not rely on salary or any one income. You must always build different income streams. Investing in different assets makes this possible because you can generate income without spending your time on it. If you are investing in a business, you need to spend all your time to run it, and there is no 100% guarantee you will make profit every time. But you have multiple options when it comes to investing. You can choose bank deposits if you don't want to take any risk but want guaranteed returns. Or you can choose your own stocks if you are good in stock market. Either way, working hard is not going to make you rich. Understanding how the financial system works and using it to build your assets is the best way to achieve your financial goals. Let me share with you the Warren Buffett's quote again. If you don't find a way to make money while you sleep, you will work until you die. If you are worried about your low monthly salary and thinking you can't able to build multiple assets, you are wrong. Let me show you how. You can build multiple income streams without a big salary. If you improve your money management and investment skills, you can able to generate better returns even with low investment. Let's say your monthly investment is 1000 rupees and average return is 8%. In 5 years, your investment will turn into 73,000 rupees and it can generate you around 485 rupees each and every month even if you stopped investing further. Now let's say you can able to generate 12% returns with your 1000 rupees monthly investment. In 5 years, your investment will turn into 80,000 rupees and it can generate you 800 rupees each and every month even if you stopped investing further. Now let's say you can able to generate 20% returns with your 1000 rupees monthly investment. In 5 years, your investment will turn into 1 lakh rupees and it can generate you staggering 1600 rupees each and every month even if you stopped investing further. That's the power of consistent investing. Now let's see the top income generating assets in India based on last 5 years performance data, and also how to generate more than 15% returns on your investment. And the first asset is gold. It is the most popular investment asset in India. Gold generated nearly 10% returns in the past 5 years. Investing in gold offers you good capital protection. If you are worried about theft, you can invest your money in digital gold and convert it to physical gold whenever you need. Also, you can sell it easily whenever you need your money. Though gold offers only a moderate return, it helps you to generate consistent returns over the period of time. Now let's move to the next asset option, which is bank deposits. Bank deposits offer low returns when compared to gold, but you don't need to worry about the theft or losing of capital. You can get your cash whenever you need. Now let's move to the next asset, real estate. Investing your money on land. It's one of the most popular investment options in India, but the problem is you need a lot of money to invest in real estate. The average returns on rental property is 1 to 10% per year. Your land value increases only when it is in prime location. Also, it's hard to liquidate real estate investments. Real estate investments are good if you are ready to hold it for a very long time. Now let's move to the next asset, stocks. Stocks are a high risk, high return asset class. You can able to generate even more than 100% returns in a short time, or you can even lose all your capital if you didn't pick a right stock. Your returns depend on various different things. Invest in stocks only after understanding how the stock market works. Now let's move to the next asset, mutual funds. Mutual funds are one of the popular investment options these days. Its returns varies based on different factors. Mutual fund is nothing but a professionally managed investment fund that collects money from many investors and invests in different asset classes like stocks, bonds, and debts. Mutual funds have medium capital risk and offer high liquidity. The great thing about mutual funds is its flexible investment options. You can invest using SIP or also as lump sum payments. Now let's see types of mutual funds. There are different kinds of mutual funds based on its investment classes and specifications. The most popular category is the equity funds, where your money is invested in stocks, and the debt fund, where your money is invested in debt instruments like government securities and bank bonds. Hybrid fund means it invests in both stock and debt fund markets. And next, index funds or ETFs. They are similar to mutual funds, but the only difference is they are traded like stocks. Now let's see how you can pick high returns generating mutual funds using moneycontrol.com. Once you open Money Control website, go to Mutual Funds and click Find Fund. Here you can see all the list of mutual funds in India. Money Control offers different options to filter all the mutual funds. Under Fund Houses, you can select your desired fund house. Under Fund category, you can select the type of fund. Let's say I want to choose debt funds instead of equity funds. Under Fund ranks, you can choose your rating. CRISIL rating helps to pick the top performing mutual funds. Under Fund parameters, you can filter the funds based on different criteria. Let's say I want to filter funds with at least 1000 crores assets under management. Under investment parameters, you can add different investment criteria. Let's say I want to filter funds that allow SIP, so I am choosing SIP investment. Once you have added your conditions, then you can click Apply Filters. Here you can sort the funds based on its returns. Always choose direct plans so that you can avoid the brokerage charges. Please note, we are not SEBI registered stock advisor. This is for your educational purpose only. So before making any investments in the stock market, please do your own research. The most important rule in investing is don't put all your eggs in one basket. Instead of investing in one asset, you can invest in 4 or 5 different assets with different returns so that you can be able to diversify your risk and returns equally. Always aim for an average return of 15 to 20%. You will definitely become rich within 5 to 10 years. Even the top investor in world, Warren Buffett, have an average return of 21.7%. We are at the final part of this workshop. Now let's see what are the things you learned in this workshop. You learned about the history of the Indian financial system, the fundamental concepts of personal finance, investment returns and 4 types of passive income from assets, the important money metrics in wealth building, cash flow management and its importance, assets first cash flow and its importance, top income assets in India and investment diversification, how to pick high return mutual funds for SIP,